It's wild, right? Like how the stock market can just do a complete 180 seemingly overnight.
Oh yeah, for sure.
You think you've got a grip on what's happening, and then bam, some crazy news drops, shakes everything up.
Definitely.
Suddenly you've got to reevaluate everything. It's exciting though, right? All these new opportunities popping up.
Absolutely. Keeps you on your toes.
That's what we're diving into today. We're taking a close look at FuboTV, that live TV streaming platform that's been making headlines.
Right, FuboTV, they've been making some big moves.
Yeah, and we've got this super interesting article from the Motley Fool published yesterday, March 20th, 2025. It digs into what Fubo's stock might do over the next 3 years.
That's a decent time frame to look at.
It is, and what makes the Motley Fool's take so valuable, I think, is their reputation, right?
Yeah, they really do their research, known for their in-depth market analysis.
Exactly. So what we want to do today is break down what they're saying about Fubo's future. They lay out two main paths. One where Fubo goes through with this big merger with Disney.
The one everyone's been talking about.
Yeah, and the other where they say, you know what, we're good on our own. We're going to walk through both scenarios and see what factors could really make or break Fubo in the coming years. Ready to jump in?
Let's do it.
Okay, so first thing first, what's the current state of play with Fubo?
Okay, so the Motley Fool article kicks off by highlighting how much Fubo's stock has exploded this year. It's more than doubled in 2025.
Yeah, I saw that. Pretty impressive, right?
It's huge. They actually point out that Fubo is one of just 8 companies with a market cap over $1 billion to pull that off this year.
Wow, only 8.
Yeah. So clearly something's got the market's attention.
Definitely. And a big part of that initial surge was the news about a potential deal with Disney, right?
Exactly. That was the big catalyst.
Where Disney would basically hand over its Hulu Plus live TV platform to Fubo in exchange for a 70% stake in the combined company.
Big shakeup. That could be massive for them.
Yeah, a total game changer. But then there's this whole other layer to the story too, right? The Venu Sports thing.
Oh yeah, that added a whole other twist.
So just to refresh everyone's memory, Venu Sports was this proposed venture between, well, Disney's ESPN parent company was in on it, and a couple of other big media companies, and their focus was going to be sports streaming. But Fubo wasn't real about it, were they?
Not really. They actually filed objections to Venu's launch. Worried about, potential anti-competitive stuff.
Right. Like, is this going to create an unfair playing field? So Fubo was basically ready to fight it.
Yep. And then there was this agreement where Fubo said, okay, they'll drop our objections.
Like, you pay us a hefty sum.
Exactly. And the number they landed on was $220 million. A pretty sweet settlement, you might say?
Not bad at all. So for a while there, it looked like Fubo was about to score big on 2 fronts. This mega partnership with Disney, plus a huge chunk of cash. It seemed like they were about to hit the jackpot.
It did. But, like we said earlier, the market is full of surprises. And this is where things took a turn, right?
Oh, yeah. Big time. What happened?
Well, just a few days after that settlement made headlines. Venu Sports itself, well, it fell apart.
What? Seriously?
Yep. Completely dissolved. The media companies involved decided, you know what? We're better off going our separate ways. It was a sudden shift.
That is wild. So it begs the question, doesn't it? Is Fubo actually in an even better position now?
Interesting question.
Because they could still get that $220 million. Even though Venu went belly up, it seems likely Fubo would keep the settlement money. Plus, there's a chance they could snag another $130 million.
Where's that coming from?
A termination fee from Disney if their deal collapses, either because Disney backs out or regulators step in and say, nope, not going to happen. So on the one hand, they're potentially sitting on a mountain of cash. On the other hand, maybe this whole Hulu plus live TV thing isn't as valuable as it once seemed. I mean, if Venu couldn't make it work, what does that say about the broader streaming landscape?
That is a good point. It really makes you wonder, is this whole thing overvalued? That's where the Motley Fool's analysis gets really interesting.
Okay, so let's get into it. They outlined 2 potential futures for Fubo, right?
They do.
One with Disney and one without. Let's start with the solo act. What if Fubo just keeps doing its own thing?
All right, so even without Disney, Fubo's financials are nothing to sneeze at. They ended 2024 with 1.7 million paid subscribers.
Which, in the grand scheme of streaming giants, that might not sound like a ton, but...
True, but...
These are people paying for what's essentially a cable or satellite TV replacement, and it's not cheap, is it?
Oh, no, it's premium service. Their average revenue per user, or ARPU as they call it, is $87.90 a month.
Per month.
Per month. That's a lot of money.
So if you crunch the numbers, 1.7 million subscribers paying almost $90 a month, that's serious revenue.
It is. That translated to $1.6 billion in revenue for 2024, a solid 19% jump from the year before.
So they are growing, that's for sure. But what about the bottom line? Are they actually making money?
Now that's the question, right? And this is where it gets interesting. Because a lot of growth companies, they prioritize scaling up fast, and profitability takes a back seat.
Yeah, they're burning cash to gain market share.
Exactly. But the Motley Fool article says Fubo's losses are actually shrinking. They even hit positive free cash flow recently. That's a big deal.
It is. It means they're not just burning through investor money anymore. They're actually generating cash.
Which is a much healthier position to be in. And the analysts seem to be bullish on a standalone Fubo, too. The article mentions projections for $2.2 billion in revenue by 2027. That's like 35% growth over 3 years.
Wow. So basically 10 to 11% growth each year, compounded. Pretty impressive.
Yeah, and even better, they're predicting Fubo will be profitable on an adjusted basis in 2026.
Adjusted, meaning?
Meaning they're taking out certain one-time expenses or non-cash stuff to give you a clearer picture of their core business performance. But even better, they're saying reported profitability. The real deal could happen in 2027.
That's a pretty rosy outlook. And then we've got the potential cash windfalls on top of that. The $220 million from Venu Sports, even though Venu itself went kaput, it seems like Fubo would still get that money.
Yeah, it's probably theirs, unless there's some legal snag.
And then there's that potential $130 million from Disney if their deal falls through. Either or both of those would be a huge boost for Fubo, wouldn't it?
Absolutely. More cash to invest in growth, expand their offerings, you name it. The Motley Fool article makes this really interesting point about Fubo's valuation, too. Their market cap right now is under $1.1 billion, and their enterprise value is just shy of $1.3 billion. So they're trading at a discount compared to their future potential. Especially if you factor in that projected 2027 revenue, we're talking about 0.5 times revenue.
Which for a company with their growth prospects sounds pretty tempting, right?
It does, and they're subjected to be trading at 14 times their adjusted earnings that year, which is a reasonable multiple. So even without the extra cash, they look pretty good. But that added liquidity, man, that would just give them so much more flexibility.
Okay, so that's the picture if Fubo goes it alone. Strong growth, improving financials, plus potentially a pile of cash to play with. But what about the other path? What if they do end up merging with Disney and absorbing Hulu plus live TV? How does that shake things up?
All right, so the most immediate change would be the subscriber count. It explodes. Hulu plus live TV has 4.6 million subscribers right now.
Wow, so they'd more than double their size overnight.
Yeah, it's huge. And their ARPU is even higher than Fubo's, like $99.22 a month.
Wow, so they're bringing in even more money per user? On the surface, it sounds like a pretty powerful combination.
It does, but the article raises this interesting point about like a potential imbalance in the deal.
Yeah, I was wondering about that because Disney would get 70% ownership, but they're contributing way more than 70% of the subscribers and the revenue.
Exactly, so it makes you think, what's Fubo really bringing to the table here, besides their existing users, of course?
Right, like what's the unique value proposition for Disney?
But it's not just about those upfront numbers, right? Having Disney as a majority owner, that comes with a lot of perks. Like, think about their marketing muscle. They're pros at getting people to sign up for stuff.
Yeah, and their reach is insane.
And perhaps even more importantly, Fubo would get access to Disney's massive direct-to-consumer audience. They've got 24.9 million people on ESPN, plus 49 million on Hulu, the regular one, not the live TV version, and then a whopping 124.6 million on Disney+.
Those are some serious numbers. It's like a built-in customer base just waiting to be tapped.
Exactly. The article says if the Disney deal goes through, Fubo's market cap could shoot up to over $3.6 billion.
Whoa, that's more than triple where they are now. The market clearly sees a lot of potential there.
They do, and while Disney as a whole is making bank on streaming, the article does mention that Hulu plus live TV might not actually be profitable on its own right now.
Interesting. But I guess the idea is that by combining forces, they could create a more efficient operation, right?
Exactly. Synergies and all that. The combined entity would have like 6.3 million premium accounts. There's definitely potential for them to make it work financially.
Okay, so we've got these two very different paths. The standalone Fubo, which seems like it has more room to grow percentage-wise.
Yeah, more upside potential.
But also more risk. And then the Disney Fubo combo. Maybe less explosive growth potential, but also a safer bet.
A more stable path, for sure.
So what's the Motley Fool's take? Do they have a favorite scenario?
Well, they're actually pretty optimistic about both options. They say, and I quote, "The future is brighter now for Fubo, regardless of what happens with Disney. It really comes down to that risk-reward trade-off. You know, high risk, high reward with going it alone. Or play it safe, but still with a lot of room to grow with Disney."
So basically, heads you win, tails you win.
Pretty much. Though the article does suggest that standalone Fubo might have a better shot at tripling in value, while the Disney Fubo combo is more likely to double, which is still fantastic.
And they even say that combo could end up being the second biggest live TV streaming platform. After YouTube TV, of course, so it's not like they'd be small potatoes.
No, they may be a major player for sure.
Okay, so the main takeaway from the Motley Fool seems to be No matter what happens, Fubo's looking good. Whether they go solo or join forces with Disney, they're set up for success. They're starting from a strong position.
That's what the analysis is saying. They've either got the potential to grow like crazy on their own, especially if they score those cash bonuses, or they can ride the wave with Disney and tap into this huge audience they've already built.
Exactly. So just to recap for everyone, we've got two possible futures for Fubo. One where they build their own empire, potentially fueled by some serious cash injections, and the other where they become part of the Disney machine with a much larger user base and access to those incredible marketing resources. And the market clearly sees the value in both scenarios, even though their valuations are pretty different.
And that's the key point, right? No matter which way it goes, it looks like Fubo's in a great spot. They're either going to be a major disruptor on their own or a dominant force as part of Disney. Either way, they're a company to watch.
Absolutely. And that brings us to a final thought for you to ponder. This analysis focused on the next 3 years, but what happens after that? What factors will determine whether going solo or teaming up with Disney was the ultimate winning strategy? Think about things like government regulations, they can make or break a company, and consumer trends. Will people still be into these bundled streaming packages in 5 years, 10 years? And what about the future of sports streaming? Is it going to keep growing like it has been? These are the big picture questions that will shape Fubo's journey and the whole streaming landscape in the long run. Anyway, thanks for joining us on this deep dive. It's been a fascinating one.
Yeah, it has lots to think about.
Definitely. Until next time.